Okay, slightly after 1 p.m., and we are officially going to get rolling here. Appreciate you joining the Traction Financial Partners 2025 Market and Economic Recap. My name is Evan Barnes. I'm co-founder and CIO here at Traction.
And I'm Drew Barnes, head of financial planning.
We appreciate you guys joining and excited to share information today regarding the markets and the economy. And we'll finish with some market perspectives and kind of our thoughts upcoming here and for 2026. There is a Q&A section that if you have any questions as we go along here, please type your questions into there. And as we wrap up the webinar, we'll make sure we cover those. But let's jump in. Okay, for today's agenda, we will start by going over the 2025 equity markets and talking about how stocks did last year. Then we'll discuss 2025 fixed income and key rates, talking about interest rates, economic update, and then we'll finish again with those market perspectives when it comes to different topics, including midterm election years. I will get us started here with the equity overview and recap from last year. As we see here on the screen, we have mostly the major indices that we track here internally as an investment committee. Just going to focus on the year-to-date column. And this is full calendar year 2025. Another really, really solid year when it comes to stock returns, and not just in one area. It looks like across the board we had really solid returns. As you see, the S&P 500 in 2025 was up 17.88%. The Dow Jones 30, almost 15% at 14.92. The Russell 2000 is small cap stocks here in the US, and that came in at around 12.81% for 2025. The Russell 2000 is off to a really strong start just in the first couple of weeks here in 2026, up over 6% in just a couple of weeks. The rolling 12 months, if you look kind of mid-January to mid-January, the Russell 2000, the small cap stocks are actually doing better than the S&P 500. It's not on this screen here. I just saw that before I came in here today. And then next up, Russell 1000 growth versus value. Growth stocks being more tech type stocks. Value, think of banks, utilities, those types of companies. So growth again in 2025 did slightly better than value. That's been the theme here for a few years. The best performing indices were international. Okay, we see the MSCI EAFE, that's Europe, Australasia, and Far East. So think of Europe, Australia, Japan. That's going to come in at about almost 32% rate of return in 2025, 31.89. Emerging markets, China, India, Brazil, Taiwan, that's going to come in at 34.36% return in 2025. And the NASDAQ finishing us off here at just over 21%. NASDAQ being a lot of those tech companies. So the theme here is that the equity markets had a really good year in 2025, which was coming off of solid years in 23 and 24 as well. Every year you do see some type of volatility. If we were doing this webinar last April, like we did do a webinar last April, we were coming off of a correction and almost a bear market. That was around the time that we saw a lot of uncertainty going on with tariffs and whatnot. But despite that 19% pullback we saw during that peak to valley in 2025, really strong returns on stocks. If we look at the different sectors as part of the S&P 500, which parts of the economy of the market did best from left to right? We're not going to go over all of them, but communication services being number one, 33.6% rate of return in 2025. Think of Google and Facebook as being the two biggest stocks in that sector. Technology and industrials would be the next two sectors that did really well in 2025. Going all the way to the right, you can see the worst performing sector was real estate. Drew's going to go over interest rates here in a second, including the 30-year mortgage, as rates remained high going into 2025, over 7%. Real estate certainly slowed down. Houses stayed on the market a lot longer. Prices thus started coming down. You saw a lot of price cuts. And so real estate naturally was going to struggle as we see rates hopefully come down some more based off of kind of how they were trending towards the end of last year. We could see real estate hopefully, potentially having a better year this year. Through the first 2 weeks of 2026, materials, energy, consumer discretion, and industrials are the top four performers. So when you look at materials, energy, and consumer discretionary stocks, they were towards the right side of this chart. The market is always kind of moving around. It's hard to predict what's going to do best based on certain economic conditions, policy implementations, those types of things. That's where we come in from an investment committee perspective to say, hey, we believe that this sector could do well over the next 12, 18, 24 months. And so those are things that we're consistently looking at. All right. As we look at the top 10 stocks in terms of size, the largest 10 stocks over the years from 2023, 24, and 25. If we focus on the right-hand side at 2025, the largest 10 stocks were NVIDIA, Apple, Microsoft, Google, Amazon, Meta, which is Facebook, Broadcom, Tesla, Berkshire Hathaway, and JP Morgan. And you can see on the bar chart here what each of those stocks did in terms of return in 2025, with Google being the top returner, Broadcom also having a really good year. But when we're looking at this, one thing that we wanted to see, or at least we were encouraged to see towards the end of 2025 in particular, was that the breadth of returns that we see in the stock market, we don't want it to be just so concentrated on the big guys. We want to see returns come from other parts of the market, international, small cap, whatever it might be, because to be so concentrated in just 10 stocks can add a little bit of risk to a portfolio. And so what you see on this chart, there's a headline here, or right below it is a top 10 contribution to return, and you see 46.8%. So the overall return on the S&P 500 in 2025, which was 17.9%, almost half of that return was attributed to these 10 stocks. So they're still big and influential in terms of how they contribute to the overall return on the S&P 500. But if we look at 2024 and 2023, they were higher numbers, right? In 2024, 60% of the return on the S&P 500 came from those 10 stocks. In 2023, it was almost 60% as well, as 57.6. So as we look at this, the trend is it's going in the right direction while the contribution's still large. They're really big companies. It's not on this chart here, but these top 10 stocks in terms of their size, they make up 40% market cap of the S&P 500. The other 490 stocks make up the other 60%. So they're big. And again, it's nice to see other parts of the market participate in returns and not just be as reliant on these 10 as we've seen in years past. We have some really nice momentum going currently in the market. And what this chart here is showing us is the S&P 500 most consecutive positive months since 2009, so since the great financial crisis. The longest period we've seen of consecutive months showing a positive return was November of 2016 through January of 2018. That was 15 months in a row that we saw the S&P 500 be positive. We are currently tied for second. We'll see how January finishes. We're 2 weeks in and currently are positive for the month of January, so we could be on to our 9th month. But currently we have 8 months in the books of consecutive positive returns. on the S&P 500. During that period of time, we've seen 24% growth total on the S&P 500. On the right-hand side, you can see the returns following the end of the streak. It can't go on forever. Eventually, we're going to have a month that's going to break the streak and have a negative month on the S&P 500. You can see each time here what the following 3 months have done. So -6%, -5% in the after the September of 2010 through April of 2011 streak was -5%, 3 months out, and then some positive returns below that. So it's a little bit of a mixed bag in terms of once the streak ends, whether or not we continue that. The question is going to be why? What's the catalyst for a negative month? Is it going to be normal volatility? Is it a midterm election with some uncertainty? What's the reasoning behind a slowdown? Is it economic uncertainty and a pullback? We'll see when that does happen, and that's our job, is to stay on top of that, to understand that volatility is a constant. Year over year, we're going to have some pullback eventually. Okay, I wanted to discuss commodity returns in 2025. All right, over the last few years, especially since 2022, inflation in particular has been under the microscope, and big driver of inflation is energy. And as you see at the top here, oil, gas, and natural gas. So you can see year over year the changes in the price of oil from $72 a barrel down to 57.40. Okay, so a big drop. I think we're still under $60 a barrel as of this morning. So a big drop in terms of oil prices. Obviously, saw what happened with Venezuela, oil production picking up. A big goal, I know currently the administration is lower energy prices. So we'll see what happens with oil, but currently it's quite a bit better than it was a year ago. Gas prices are below $3 a barrel nationally. Depends on where you live. It could be a lot better than this 281 that we see on here. You still have some states that's $4 or $5 per gallon, but gas prices down. Natural gas, though, is one part of the energy commodity sector here that is up from 340 to 369. But overall, when we take a look at the picture on the energy side of things have cooled off over the last year, which should lead or help lead and keep inflation in check. Gold, silver, copper. All right, when we talk about precious metals did really well in 2025. Look at gold from 2609 to 4368. Silver, even a bigger jump, $29 to $72. And the reason behind that, a couple of different reasons, but a big driver is going to be the dollar. Okay, you think of gold, silver as hedges against inflation, which they could be. I think that historically, though, stocks tend to be a better hedge against inflation. Gold and silver, tangible type assets, tend to be more in favor when there's a concern about the value of the US dollar. Earlier in the year, particularly in 2025, the value of the dollar dropped. We had a lot of uncertainty around tariffs and all this type of stuff, but also the fact of the matter is we have 37, 38 trillion in debt as a country. We're running $1.5, $2 trillion deficits. As we continue to borrow, maybe print money, whatever that might be, that just adds uncertainty and devalues the dollar. If that continues, that's why gold, silver, and those types of assets tend to become more attractive. Actually, starting tomorrow, we are doing our semi-annual rebalance in our models. One of the sectors that we're adding is a commodity fund. It's not just silver and gold. It also has energy, because we don't believe energy prices are going to go down much more than they are currently. And as Drew's going to talk about from an economic perspective, if we grow at the rate that could be expected or is expected, we believe that energy companies will also do well. So we are adding a small allocation to the commodity sector as we do our rebalancing here, because we believe that this is a good time to continue this run going into 2026. I'm going to pass it over to Drew and let him discuss fixed income, and then he will also go into the economy.
Thanks, Evan. All right, so when we look at fixed income, it's certainly not quite as exciting as the equity markets, but nonetheless plays a pivotal role in our portfolios, particularly for those who are retired and living off of their portfolios, because we need the bonds help generate uh, income for us, and of course they kind of serve as the ballast to the portfolio to provide diversification. So that way, if the stock market's down, we should have a portion of the portfolio that's hanging in there, if not appreciating in fixed income. So not quite what we saw in the equity markets, but if we look at our top line here, the U.S. Aggregate Bond Index was up north of 7% last year. So it was a strong year for bonds. So, to get 7+% in your bonds and then to be getting mid to high double digits on your equity side, it was just really a strong year overall for the capital markets. And if we're looking at the yield that the aggregate bond index gives us, currently bonds are yielding about 4.32%. So, if bonds are yielding about 4.32% and they were yielding higher last year at the beginning of the year, how do we get to 7+% in returns? Well, that's because we experienced a decline in rates last year. So as rates go down, bond prices go up, and vice versa. As we learned and lived during 2022 when rates went way up, we had a very poor year in bonds, with bonds being down double digits that year. So we got some relief, not in an extreme way, but we got some relief on interest rates last year. If we look at the column where I'm hovering the mouse, we started on the 10-year Treasury at 4.58%. We came down about 0.4% to 4.18%. And 2-year Treasuries, so shorter term interest rates, dropped more, going from 4.25 to 3.47. And there's other rates on here that we won't spend much time on, but Evan mentioned mortgage rates earlier. And so mortgage rates are going to be very closely tied to the 10-year Treasury in terms of direction in which they're moving. Obviously, it's not a 1-for-1 with the 10-year Treasury being in the fours and mortgage rates being higher. But with mortgage rates last year starting at 7.28, ended the year at 6.25. So down over 1% on mortgage rates last year, which is a welcome sign for folks who are actually in the market to buy right now, and having to either, whether you're a first-time buyer or having to forfeit that lower rate that you had if you're moving. And where we sit today, we're actually just above 6%, 6.04. So rates have continued to come down. And again, some of that is market forces, with just the market driving rates lower. But the Trump administration has instructed the organizations Fannie Mae and Freddie Mac to take some of the liquidity in which they have and buy bonds. So they're buying approximately $200 billion worth of bonds. And again, as you buy bonds, that means prices are going up and therefore rates are going down. So just in a couple of weeks, we've already seen those rates come down quite a bit. The 10-year Treasury at about 4.16, which is a little bit lower. We've actually seen the 2-year Treasury go up. So short-term rates are going to be much more closely tied to what the Federal Reserve is doing, whereas longer-term rates and mortgage rates are going to be more market-based. So we, came into 2025 expecting, kind of our saying was, we think bonds are going to be bonds again. They very much were. They paid us a solid rate of interest, and then we actually got some appreciation. So they served as good diversification during the volatility in April, and had a pretty solid year overall. Now, when we look at where we sit today and what hypothetical returns on bonds might be, again, there's a lot of different types of bonds on the screen. We'll just focus on this top line here. So we've kind of got our base case if there's no change in rates, and we just are simply going to get the 4.3% approximately that bonds are paying, because there won't be any appreciation or depreciation in the price of bonds. So we simply just get 4.3. In the bear case, if we see rates go up by 0.5%, we're going to get 1.6% on bonds because, again, as rates go up, we will lose value in our bonds, and we'll still get whatever the net yield is, less whatever we lose in value. If rates go all the way up by 1%, then we'll be down 1.2%. The bull case, and again, it's always very difficult to predict markets, particularly interest rates. But in our investment committee, while we don't expect there to be major movements in longer term bonds, which is effectively measured here by the aggregate bond index, if they are to move in any one direction, we would probably anticipate them to slightly move down. So we think they'll kind of hover where they're at, maybe move down slightly. So if rates go down 0.5%, we'll make 7.1% or so in our bonds, similar to what we did last year. If we go down by a whole percent, we might make almost double digits, 9.9%. So the break even is 0.72%. So if rates move by 0.72% one way or the other, that's kind of our break even. So if they go up by 0.72%, we'll be flat on bonds. So just to kind of give you the landscape of where bonds are at right now, we still think that they are positioned to have a solid year. And if we do see rates come down, which again is the intention of this current administration, and if we see inflation ease, things like that, we might see rates trend a little bit lower. Speaking of the Fed, so the Fed controls short-term interest rates and with their federal funds rate. And so a lot of people have a little bit of a misconception when they think, okay, the Fed's cutting rates, so mortgage rates are going to come down. Well, there might be a minor influence on mortgage rates as a result of what the Fed's doing. But again, it's going to be largely market-based. But short-term rates will follow what the Fed does to a much greater degree. So if we look on the far right-hand side in our little table, the Fed started the year at 4.25%. There was 3 total interest rate cuts last year, so now they're around 3.5%, so down about 0.75. The 2-year Treasury, where it started, where it ended, almost the exact same, fell slightly more than the Fed funds rate, but pretty much in lockstep. So and then if you look at the 10-year Treasury, like I mentioned earlier, it fell about 0.4. So what is the market expecting the Fed to do? And again, the Fed is data dependent. So they have a dual mandate, which is inflation on one hand and employment on the other hand. And we'll look at some data on that in a moment. But where we sit today, the market expects the Fed to cut either 2 or 3 times at 0.25% per cut. So we're at 3.5 right now. And if they cut 2 to 3 times, the market's saying, okay, maybe we get 2-ish cuts and we'll be at about 2.9%, which is a decline of about 0.5%. We would expect 2-year Treasury and short-term bonds to follow that pretty closely. And we don't really know that it's going to have much impact at all on longer term bonds like a 10-year Treasury. So from a fixed income perspective, the risk return profile is pretty attractive to be in shorter term bonds because they're still yielding pretty solid rates, not quite as much as longer term bonds right now. But if the Fed does cut as projected, we'll see some appreciation out of those shorter term bonds where appreciation is far less of a certainty from longer term bonds like a 10-year Treasury. So that's where we stand on the projections for the Fed and what we'd expect short and long term rates to do as a result. So that leads us into our economic update. And I mentioned that the Fed has a dual mandate, the first of which is steady prices. If the chart in front of you is any indication, they did not succeed in having stable prices since the beginning of 2018. We see that big spike peaking in June of 2022 at 9.1%. And then in the colors there, you can see the various contributors to CPI. If we look at the far right, this chart is updated through the November Consumer Price Index, or CPI, at 2.7. Well, December has just recently been released this week, and it was also at 2.7. So inflation's at 2.7, kind of hovering, from where we started last year, up right around 3%. We dipped down to as low as 2.3, came back up to 3, and now we've come back down a little bit. So there's a few things I want to point out here. One is that if we look at the colors of what makes up the latest inflation, we can see the two biggest contributors, the dark blue line here, which has by far been our biggest contributor, is shelter. So that's rents and things like rent equivalent for homeowners. And we're starting to see home prices roll over. We're starting to see rents come down. And so it's lowering its impact on inflation quite a bit. And that's a big thing because shelter is the largest component of the index. So if shelter prices are coming down, we can expect inflation to trend down as well. The other is dining, recreation, and other services. So kind of the services component of the economy. We're seeing a little bit of inflation there, and then some small contributors there in food and energy. And as Evan pointed out earlier, energy's been on the decline. So we would expect to see energy reverse course and probably actually be below the 0% line and probably pull CPI even lower. So our expectation is for inflation to at least kind of remain where it's at, if not trend a little bit lower, as we see rents continue to decline a little bit, and home prices, which have totally stagnated, if not fallen in most markets. And then energy, as that continues to roll over on the year-over-year metrics, it'll start to pull down inflation in all likelihood as well. And then the other thing I'll comment is that, when the tariffs were initially rolled out, one of the major concerns from some folks was that it would lead to inflation. And there's a reason that this chart points out to April of 2025 at 2.3%. That's when the tariffs were rolled out. And so inflation did go up a little bit in the subsequent months, but I don't think you can really blame too much of that on the tariffs, because tariffs will impact most likely core goods in terms of what we're looking at inflation, and that's the orange bar. And you can see that's been a pretty low contributor. So maybe 0.2%. But the main takeaway is tariffs certainly did not lead to any kind of major inflation, and that's going to be a one-time bump. The tariffs that went into effect last year are just still in effect, so it's not like you get a new tariff on top of it. So that effect, to whatever effect it did have, should be minimized moving forward. The other side of the Fed's mandate is employment. And so what we have on the screen is month by month net job additions. And then you can see the light blue line, which is a 3-month average. And we've seen employment basically come to a halt. October was a really bad month. Almost all of that is contributed to the federal government employees that took the buyout option that the current administration offered. That happened at the end of September, and therefore in October, they no longer had those jobs. So it's kind of a one-off anomaly there, which dragged us down to basically 0 to slightly negative net job growth over the last 3, 4, 5 months. And I'm here to suggest that that's not quite as alarming as it may appear, because I think there's some driving factors that are contributing to this as a result of policy from the current administration. And so what does that look like? So what are the likely causes of this stall we've seen in employment? So the first category there is net international migration. So in 2024, we had 2.6 million people, estimated approximately 2.6 million people in terms of net migration into the country. In 2025, we're estimated to have lost which I believe is the first time in around 50 years, about 360,000 in terms of net migration. So it's our first negative net migration in quite some time. And obviously the policies that lead to that is the border enforcement and things like that. So those 2.6 million people that came over in 2024, and it was just as high, if not higher, in 2023 and the year before, is that they mostly came over and got jobs. So if you go from a plus 2.6 million to a negative 360, we're looking at a swing of 3 million people that are no longer getting jobs. Number two there, federal government net employment. In 2024, the federal government added 439,000 jobs. In 2025, they subtracted 277,000 jobs. So that's a swing of over 700,000. So net migration, not as many people to hire. Federal government subtracting from employment. And as we saw, the big drop in October, certainly kind of the proof was in the pudding there. And then we look at automation. And I think this is yet to be seen in terms of the true degree in which this might take hold over the years to come. But there's a primary consulting firm in the economic and employment data market, so to speak, Challenger, Gray, and Christmas. And so they have a lot of good employment data. And they recently said that AI was responsible for approximately 55,000 layoffs last year. So in addition to those layoffs, which 55,000, that's obviously a lot of people, but in the grand scheme of a country of over 300 million, like not a huge number. But companies are not just laying some people off as a result of automation and AI. They are changing hiring practices and no longer hiring people they may have 2, 3, 4 years ago because of the extra productivity they're able to get out of their current employees who are now utilizing AI, or just jobs that AI can flat out do itself. So you factor all these together, and I think it kind of brings some context to the employment situation. And I think it's more of a reset based off of policy changes from the new administration prior to the last. Last on the economy is we'll look at GDP growth. And if we look at 2025, the first quarter we were slightly negative. You can see this big purple bar here, which is net exports. That was basically entirely why we were negative, and that is because companies were front running the tariffs they knew that were coming in April to start quarter two. That fully reversed in the second quarter, where we were up 3.8% on GDP. Quarter three, we were up 4.3% in GDP. And this is the Atlanta Federal Reserve Bank. They kind of specialize in live, up-to-date GDP estimates. They call it their GDP Now estimate. And for the fourth quarter, the estimate they released just this morning, 5.3% GDP for the fourth quarter. So we're really seeing economic growth start to swing positive in a big, big way. I've seen some estimates expecting GDP growth in 2026 to be anywhere from 4 to 6%, which would be by far the biggest numbers we've seen in quite some time. And there's a lot of main reasons for this. One is the AI boom that continues to be a main economic driver. We're seeing a lot of big data centers going up to be able to power this AI. That means we have to also develop energy sources to power those data centers, and those are being constructed as well. Part of the One Big Beautiful Bill Act that was passed last year created really, really strong tax incentives for companies to build plants and manufacturing in the US. And there's things like 100% expensing, which is just kind of unheard of. So you can build a plant and all of the factory equipment that you need and expense all of it in the one first year rather than depreciating it over a long period of time. So there's a lot of strong tax incentives that are leading to a lot of economic activity, and we're really starting to see that take a swing up right now as a result. And again, AI is kind of the primary driver there. So we are pretty pleased with where growth is trending for the U.S. economy. And then as a result of that, and with the new tax law that incentivizes companies to produce in the United States, Evan mentioned how we're adding a commodities fund to some of our models. We're also adding a fund that invests in companies that produce and manufacture in the United States, where at least three-quarters of their income comes from the United States and not overseas. So we think that that area of the economy is really poised to be positioned for strong returns. I'll quickly go through this slide here. Tariffs, when they were initially rolled out in early April at the peak, they hit 30% effective rate. And that's when we saw that big market decline that then led to a lot of negotiations and trade deals with various countries and blocks like the EU. Now we're down to 15.6. And the market's taken that in stride. Like I said, it hasn't led to runaway inflation like some feared. Corporate profits grew at a really impressive clip last year, expected to grow by almost 15% again this year. So it's not really eating into bottom lines for companies. But if you look at where this is from a historical perspective, you got to go all the way back to the mid 30s since the last time we've seen tariffs like this. But so far, they've proven to not have a negative impact on the market and haven't really had a negative impact on the consumer either. And our last slide, when we're focusing on the economy, is this is Russell Investments. They put together a global economic monitor and indicator for various markets. So if we look at the US in this column, based off of various areas of the economy, Europe and the UK, and then the Asia Pacific. Kind of like I was mentioning, the US, you can see gray is neutral, green is good, yellow is potential warning sign. The US is in really good shape here. It's neutral to positive. Europe and Asia is more of a mixed bag. So overall, we're expecting the US to be well positioned to do well moving forward in terms of various economic scenarios, 35% neutral, 40% bull. So three-quarters of kind of the economic scenarios are neutral to good. And then, of course, there's always the potential for some bad. But if you look at their swing versus the end of the third quarter, 20% went from neutral to bull. So similar to Russell, we are pretty bullish on where the US economy is heading as we work our way into 2026. And with that, to bring us some market perspectives to wrap us up, I'll pass it back to Evan.
Thank you, Drew. Okay, we are down the home stretch here, and we'll finish with some market perspectives. 100 years worth of calendar returns on the screen. And you can see each calendar year put into its category in terms of how it finished the year of returns. The chart over here on the left-hand side, talking about the 100 calendar years, the average at 12.4, median return 15.4. This is on the S&P 500, annualized at 10.5. The best year, 54%, the worst year, 43.3. As we look at the years and the different columns here, you can see last year, 2025, has been placed at the top of the 10 to 20% return column. That has the most number of years in it. If we go one to the right, between 20 and 30% rate of return, that has the second most number of years in it. Let's go one more to the right, between 30 and 40, that has the third most number of years in it. So as we look at this chart, what kind of stands out to me is that one, about 3 out of every 4 years is in the positive. And the other part is when the market's up, it's usually up pretty strong, right? So the best way, as it says here in the title of this slide, to build wealth is to be in the market. And so whether you're a moderate investor, aggressive, whatever it might be, depending on your allocation to stocks, being in the market is the best way to build wealth over time. And so this is a good look back at history. On the left-hand side, I'll wrap up with this one on this slide is look at the negative returns between 0 and -10. That has the most number of years in it. Between 10 and 20 has 6 years that fell into that category. As you go further to the left, we've only had 6 years total out of the last 100 years that were down more than 20%. One that was down more than 40. Okay, so again, when the market's up, it's usually up pretty strong. On the downside, it's really unlikely to get those kind of catastrophic years. Not that it can't happen, but it's more rare. All right. How about consumer sentiment? How people are feeling? Okay, consumer sentiment largely reflects, economic conditions, how people are feeling, about their prospects, those types of things, as opposed to kind of the future of the market and the market direction. The stock market is very forward-looking. Okay, and when we see the market data come out and say, hey, the last quarter earnings were X and profits were Y, like that's good to know. We want to know how healthy companies are, but we really like to focus on what the companies are saying the next quarter is going to look like. We want to see what they're projecting in terms of, hey, we made $10 billion last quarter. Next quarter, we're looking to do 12 or 13. And so the market itself is usually kind of ahead of where people are feeling. That's kind of the Warren Buffett, be fearful when people are greedy, and be greedy when people are fearful. In 2025, November of 2025, on the consumer sentiment scoreboard here, we are at 51, which is in this low category. The high category is 94.4 to 112 on the far right-hand side. These charts show us the average return 1 year out from the particular score for that year. The average return when the sentiment is as low as it is, 12 months out is 16.4%. Okay, so despite sentiment not being as good, the market again is kind of forward-looking. The economy is looking better. There's a lot of investment going on. And so just because you see some headlines saying things aren't as great doesn't mean the market's not going to do well over the next 12 months. It tends to do well. All right, we are in a midterm election year. And when it comes to volatility or standard deviation is how we measure volatility in the market. This chart will show us the 4 years of a presidential cycle. You can see quarters 1, 2, 3, and 4 in the first year of a presidential cycle, pretty calm. That was kind of like last year. Well, after April 8th, the rest of the year was pretty calm last year. Midterm election years tend to be the most volatile. And you can see that here in year 2 of a presidential term and the presidential cycle. Midterm election years, the volatility tends to be higher. The market, like we just discussed, kind of operates on certainty, predictability. And when we don't know as investors, hey, who's going to be in control of Congress? Who's going to run the House? Who's going to take control of the Senate? What type of policies can we see come out? Taxes, regulations, all that kind of stuff. Until we get closer to the election itself, it tends to be pretty volatile. And this chart here is showing us the quarter before the midterm election. Okay, so that'd be quarter 3. The quarter of the midterm election, and then the quarter after, so the first quarter of the following year. And you can see during midterm election years, the quarter before the elections actually happen, in Q3, it's pretty flat, right? 1.1%. In non-midterm election years, it's closer to 1.7. But check out this chart here in the middle. The quarter of the midterms, right? The midterms are in November, so you have the rest of November and December. After the election's done, we now know who's going to be in charge of the government come the following year when everybody's sworn in. There's more certainty, there's more predictability. The market can then kind of plan based on what the expectations are. 7.6% is the average return during that quarter of midterm election years. Non-midterm, it was 4.2. The quarter after that, the first quarter of the following year, it's 8.2% is the average return for the quarter after midterms. So again, the market just wants to know, and that's kind of the theme of this slide here. Um, and with that, we want to try to keep it to 45 minutes. I think we came pretty close there. Um, we're wrapping up. I'm going to check here on Q&A in a second, but wanted to just touch on a couple of things here. We are going to be doing our model rebalancing starting tomorrow. You should be seeing, if you're in one of our models, you should be seeing a memo come out saying, hey, you're in the growth model and it'll be rebalanced. Here are some of the changes that are going on. Drew and I mentioned a couple of the funds that are being added to a few of the models. So that over the next week is going to be happening across our portfolios. And also, we wanted to give a shout out here. Randy Anderson, wealth advisor here with Traction Financial Partners, just an absolute Social Security expert. For more than a decade, Randy's been one of the top speakers on Social Security in the Denver metro area. He's had articles in the Denver Post, all that type of stuff. Randy's fantastic. He is doing and it should say seminar on here, actually. That's my fault. An in-person seminar, March 11th. This is still tentative because we're still waiting on the contract. Likely going to be the evening of the 11th at Arapahoe Community College. We will be sending out details, though, once that is confirmed. And so be on the lookout for that. I'm going to check the questions here. And then as I'm doing that, I will do the obligatory clicking forward through the disclosure pages. Okay. I do have one for Drew. Go back now to question page. So, Drew, the Supreme Court is looking into the tariffs, and not that we want to have you predict what will happen, but how is the market currently viewing the potential that some of the tariffs that have been put in place may have to be unwound?
Yeah, I mean, that's a really good question. And like you said, we don't know how that ruling is going to come down. And I've actually seen some analysis that they may kind of split the decision and that they may actually say, okay, current tariffs can maybe stay, but there can be no new ones without congressional approval. And the reason behind that is so much of the tariffs are part of these trade deals that were made. And these trade deals have trillions of dollars of investment and capital coming into our country to stimulate our economy, build factories, hire people. And so I think that they may understand that that could be too big to unwind, quite frankly. And then that will obviously put a big strain on the budget if we have to refund hundreds of billions of dollars worth of tariffs. From a market perspective, I think it's also kind of a split decision. I think that the market sees it as a positive in that if companies aren't having to pay any tariffs, that kind of helps out the bottom line. And then on the flip side, they may say, okay, well, if all this capital investment doesn't come into the country, that could impact what we were projecting for a lot of these companies that were going to be utilizing that capital. You know, you've got a bunch of companies that have plans to break ground this year on building new plants and things like that. So if they don't do that, then I think that impacts in more of a negative way. So I know I kind of punted on that question and covered both sides of it.
The Supreme Court punted their decision this week anyway, so you're not the only one.
So it's a tough thing to say, but I don't think it's going to have an outsized effect on the market one way or another. It might cause some short-term volatility, but I think there's pros and cons from a market perspective to either outcome.
Looks like there was one here, one more.
Yeah, one other question.
Me, I'll let you read it and I'll
try
to tackle it.
In 2025, we saw for the first time international markets being the top performer for quite a while. Is there an expectation for that to continue into this year, or is that seemingly kind of a one-off?
Yeah, and again, I'll dance around it a little bit, but the um, historically, when international stocks are in favor, it tends to be that way for a little bit. That doesn't mean that the U.S. stock market can't do better or keep up with international stocks. Our view is that if there's a potential that the dollar continues to be a little bit soft, I don't think it's going to retreat kind of the way it did at the beginning of last year. International stocks gain a little bit of favor that way. But the fact is that you showed that the U.S. economy is projected to do well compared to our international friends. Um, and so, especially with the AI investment, the AI boom is here. It's based in the U.S. So we're kind of positive and confident across the board when it comes to international stocks as well as U.S. stocks. The good news also is that even when we invest in large mega cap U.S. corporations, they do a lot of business overseas too.
Right.
So even the S&P 500, I think it's something like 30 or 40% of their revenue comes from overseas. So not that that's an international company, but it's a very global market. And so you get exposure that way as well.
Right. All right.
Think that's it in terms of questions. I don't think see anything else coming in. Um, That's it for us. We will post this to the website, to our YouTube channel. Um, Please share with others. And if you have any questions as you kind of digest everything that we've gone through, please reach out. And we hope you have a fantastic rest of your day and a fantastic weekend coming up. Thank you very much.